...24 seconds away from the opening bell in New York City this morning. Good morning. The IMF finally catching up, dropping their outlook for growth, kicking higher their outlook for inflation. We've been talking about that all year. Equity futures on the S&P 500 essentially unchanged. On the Nasdaq, positive about 0.1%. On a Russell, we're negative on the Nasdaq 100 by 0.2%. As you open and bow, switch on the board and get to the bond market. What a move we've seen in treasuries, particularly the 30-year. Very briefly, through 3% for the first time since 2019. On a 10-year, above 290, 290.70, and up by more than 5 basis points today. It is not just the treasury market, it's Europe too, with German bund yields breaking out as well. Euro dollar positive 0.1% at 107.94. A bigger move in dollar yen we've discussed a little bit earlier this morning. And a move to the downside on crude. WTI down by 3.4% at 104.50. So in about 30 seconds into the open, we're down 0.5% on energy stocks this morning. That's where your underperformance is. The S&P more broadly is basically flat. Real estate outperforms up 0.5%. Industrials too up 0.4. Financials as well up by 0.4%. Breaking down some of the early movers. Back with us is Taylor.
And John, let's start with some of those energy movers, right? I mentioned Halliburton, of course, at the top of the hour. Quickly, just want to revisit, of course, as we get further comments, not only about the write-down of the assets over there in Ukraine, but talking a lot about the supply chain issues pretty much across the board, and of course, in Russia. So you're really seeing those shares off just about 1.5% or so. Travelers, look, there's a first quarter that missed analysts' expectations. And analysts over at Piper Sandler said that the underlying margins were worse than expected. You take a look at Lockheed Martin as well. Sales falling 8% year over year and falling in 3 of the 4 categories. The one category that did see a year over year increase was basically UNCH. So that sort of explains that picture. Finally, Alibaba here. You know, John, this has sort of been a bellwether perhaps for some of the Chinese stocks. The latest news, of course, just further crackdowns, in particular in the live streaming case as well, the concerns over the delisting of Didi. And so Alibaba, of course, another big loser on the day.
Taylor Riggs, thank you. Twitter, a name we need to talk about as well. Small move to the downside on Twitter. Apollo enters the building, maybe to support Elon Musk, maybe to enter the building with its own bid. Let's get to the West Coast and catch up with Ed Ludlow. Morning, Ed.
Yeah, good morning, John. Bloomberg sources saying that Apollo will get in on the act, right, either as a supporting act alongside the Musk bid or another bid, potentially Thoma Bravo, for example, whose hat's already in the ring, could be in the form of credit or preferred equity. And down 2 percentage points on Twitter on Tuesday. The 8% gain we saw Monday was the biggest jump since April 4th, which is, of course, when Musk first disclosed his stake. And speaking to folks at the company, speaking to investors, it seems now that we're moving in a direction where the poison pill's been instituted by Twitter, confirmed in a regulatory filing Monday. The outcome, whatever it may be, because we're still in the game, is more favorable to investors. That seems to be the direction of travel that we're now moving in. It's interesting because it could be Musk that does this, but on the table now seems to be this idea that it could be any number of combinations of a consortium of private equity if Musk is not successful. I took a look on the Bloomberg, John, FA Go, and looked at some of the financials. And what's really interesting here is that Twitter's revenues due to top line growth of around 17% this year, jumping to 22% this year. But I log on this morning and I saw Bloomberg Intelligence with a really smart note saying, why would Twitter hang around on any offer? Why don't they just do it, go private, because it would unlock value in terms of product innovation and ultimately growth. We'll wait and see on that one. But ultimately, the stock is down 2%, John. It's hard to know if this is just leveling out. I would say we got a disclosure 13F from ARK that they, for the first time in 5 quarters, cut their stake in Twitter.
I won't get too excited about the move this morning. One thing that gets my attention, Ed, is that you also cover Tesla. That's gone quiet. What are investors saying about that story, given what's developing with Twitter?
Yeah, interesting. I mean, back when this all started to unfold and there was some selling on Tesla stock, the idea was that Musk might have to sell some of his shares to fund a deal for Twitter. But alongside that, we're super focused on Shanghai. There are media reports, local reports, that the factory in Shanghai has restarted after that shutdown where the government was conducting phased testing. Shanghai is just so critically important, and with earnings around the corner Wednesday night, we want to know what the impact of that, how unsettling or derailing was the shutdown shutdown of that plant in the bigger picture of this year.
Hey Ed, great coverage as always, buddy. Good reporting. Ed Ludlow there on the West Coast on the Twitter and Tesla story. Tesla just about positive on the day, up a third of 1%. Ed mentioned Shanghai. Early this morning, Bank of America, overnight in fact, cut their outlook on China GDP from 4.8% to 4.2%. That was the base case. The bearish scenario, they put a 3 handle on Chinese GDP at 3.5%. That's their bearish scenario, something to think about given the disruptions from COVID controls and zero COVID, which B of A thinks is going to be the policy effort from the Chinese government all the way through to the Chinese People's Congress later on this fall. So look out for that, and look out for more downgrades too. B of A not alone in doing so. The story for after the close is of course Netflix. Year to date it has been absolutely battered by more than 40%, down 44% year to date in 2022. Wells Fargo calling it a quote wait and see quarter, with investors likely resetting afterwards. Kaylee Lyons taking a look for more. Hey Kaylee.
Hey John, yeah, it's been absolutely brutal for Netflix going into this print, and once again it's going to be all about the subscriber story. 2.5 million net additions are expected in the first quarter, but what does the outlook look like, and how has the recent price hike as well as the pulling out, the suspension of services in the Russian market impacted the business? That will be the question we look for answers to later on this afternoon. Of course, Netflix really just the first of the big tech companies to report. Tesla's due tomorrow, then Microsoft, Alphabet, Meta, Apple, Amazon, all throughout the duration of next week. And as for how sentiment is shaping up ahead of those reports, once again, we've been heading south for big tech. You saw how painful it's been for Netflix, but for the broader NASDAQ 100, which houses a lot of these large cap tech stocks, it had a really rough start to the year, falling 20% from January 1 to mid-March, then staged an impressive rally through the end of March, and once again the direction is lower. We have cut those year-to-date losses and now down about 16% on the year. So it's looking like that rally we saw at the tail end of last month may have been a bit of a false start. And of course the thing weighing on a lot of these stocks in part is just higher yields. Higher borrowing costs put pressure on stocks that command higher multiples, which many of these players do. But there's other factors here as well, including consumer confidence and the issue of discretionary spending. If you are facing inflationary pressures at the gas pump, at the grocery store, are you going to want to spend on Netflix and other streaming subscriptions or buy that new iPhone? Speaking of iPhones and production issues, supply chains also a big factor here, as well as the broader issue of attracting and retaining talent. All of these headwinds that tech companies are facing, John, we'll see how far they can push through them when we get these reports in the next couple of weeks.
Just quickly on Netflix, have you cancelled any subscriptions whatsoever, Kaylee Lyons, in the last couple of months?
I canceled Hulu.
There we go.
Yeah.
The full package. Because my Hulu package costs a fortune.
I never had the full package to begin with, but I got over Handmaid's Tale and I was like, eh.
Nothing left. Kaylee Lyons, thank you. Not alone. If you look to the United Kingdom, the FT reporting earlier this week the following, that we have seen British households cancel video subscriptions in record numbers as they curb non-essential spending to cope with the cost of living squeeze, reinforcing concerns that a pandemic-fueled boom in streaming is over. Now, what's interesting to me about this story, and this is backed up by Cantor Research, by the way, is that we always talk about these names as if they're just secular growth stories, that they're immune from what happens with the economy. But this is an economic story now. Are people going to cut back from the 25 streaming subscriptions that I know many of you have got? Of course, I'm talking about myself, given what's happening with prices recently. Perhaps. Stuart Kaiser of UBS joins us now. Stu, you think that maybe there's an opportunity here in technology. The risk-reward has improved. Why?
Hey, good morning, Jonathan. Yeah, that is our view. Essentially, as Kaylee mentioned, a lot of these tech stocks have been really punished by the move higher in yields and by the shift more hawkish in Fed pricing. Our view is that inflation probably peaked in the most recent print. And as that inflation comes under pressure, it should kind of take, some of the sting out of hawkish pricing going forward, and that collectively should read positively for tech. I mean, if you think about this, it's a pretty clear feedback loop from high inflation to more hawkish policy to investors being concerned about the growth outlook. And we do think that we're sort of past the max pressure point from that.
Just to work through this with you, Stu, so we're working through this pivot from inflation concerns to growth concerns. I've got all that. In the meantime, what we've seen is a pretty defensive bias in this equity market with cyclicals underperforming, and we've seen the more defensive parts of the market outperforming. Are you saying there's an even bigger reason then to stay away from the cyclical parts of this equity market? There's no reason to lean in there whatsoever?
No, I mean, I think those calls are related, Jonathan. I think, essentially what's happened is the Fed has gotten hawkish enough that people have started to get worried that they're going to over-tighten and materially slow U.S. growth. And I think that's ultimately what's caused cyclicals to underperform. You mentioned earlier utilities versus banks. I think one of the reasons utilities has been able to weather the move higher in yields is because folks are worried about growth and they're trying to hide in a more defensive part of the market, whereas financials have been on the other side of that coin. So I think these things are pretty related, just in the sense that the Fed pricing got to a point where people started to question the growth outlook. And as inflation comes off, that pressure should ease. That should open the door for, I think, cyclicals to recover a bit. And from our perspective, tech has been the area of the market most punished by that combination of higher yields and inflation. And we do think that the risk reward is kind of improving there.
Stu, where do the banks fit in?
Look, to your point, the banks theoretically should be doing much better in a higher rates environment. I think the problem is that the growth outlook has been hit as well, and there is a cyclical aspect, particularly from a domestic perspective for banks. And I think that's probably why they've underperformed. If you go back to earlier in the year when rates were rising, banks were doing just fine. So I think banks were able to track the move higher in yields up until the yields reached a level where it became a serious headwind for growth. And then you saw banks start to underperform. So if we do get in a situation where yields are, higher than they were, 6 months ago, but this recession risk discussion eases a bit, I think that does allow, hopefully, financials to recover a bit on a relative basis.
Let's just finish on tech quickly. Best way of expressing that trade, Stuart, for you and the team, what is it?
We're keeping things pretty simple. We like July call options on the NASDAQ 100 as sort of an opening bid here. Admittedly, we could be a little bit early. Obviously, NASDAQ's been under a little bit of pressure this week, but we do think you want to start there. The other part of the tech space, which has underperformed significantly, has been semis. Because of the supply disruptions, I think that one is kind of a little bit fraught right now in terms of stepping into it. So, we're keeping a really big picture and staying with NASDAQ 100. If you wanted to get aggressive, you'd start to toy around with that profitless tech part. I think, to me, that's a step too far at this stage, and we would just stay with NASDAQ 100.
Do you need the long end of the Treasury market to settle down for this to work?
I don't think you need it to fall, but I do think you need, rates volatility to calm down and the rapid increase we've seen in yields to kind of calm down a little bit as well. Bond volatility has been a little bit of a bugaboo for equity markets for the last, 4 to 6 weeks, if not longer. So, bare minimum, I think you want to see bond volatility come in and at least rates stabilize a little bit so that, so investors can build a base case. Frankly, It's been hard to build a base case these days because your base case is useless, the next week. So if it just calms down a bit, I think that would be incrementally positive.
Hey, Stu, it's been a struggle, that's for sure, in the bond market. Stuart Kaiser there of UBS. We closed out the month of March looking at yield curve inversion. Then all this steepness kicked in a massive way. Your 10 years up another 6 basis points today. Just a little bit of flatness, actually, today, with the front end driving higher by 9 basis points to about 254. Taylor Riggs writes in, Hulu. Taylor, nothing left. Kardashians are on Hulu, you crazy people. Do you think that makes a difference, Taylor?
You can't unsubscribe to Hulu right when they get the Kardashians, John.
Do you think that's going to be the game changer for Hulu? I'm not going to lie. I came back from vacation and I watched episode 1.
Told you. I knew
just
it.
For you. Kendall wasn't in episode 1, though.
Oh, John, look at you
for
go.
episode 2. You're proud of me. Taylor Riggs, thank you. Coming up, a US judge overturning the mask mandate on planes.
So this is obviously a disappointing decision. We're continuing to recommend people wear masks.
The control room can't believe it. The conversation is up next.
CDC recommended continuing the order for additional time, 2 weeks, to be able to assess the latest science in keeping with its responsibility to protect the American people. So this is obviously a disappointing decision. We're continuing to recommend people wear masks.
The US is shedding its masking mandate for public transportation. The TSA running in a statement the following: today's court decision means CDC's public transportation masking order is not in effect at this time. Therefore, TSA will not enforce the security directives requiring mask use on public transportation. Joe Matthew joins us now from DC. Now, Joe, you and I went back and forth on this morning. On the record, they're disappointed. I just wonder how disappointed the administration actually is, given they had another decision to make on this in just a couple of weeks' time anyway.
Well, that's true. A lot of people don't realize, Jonathan, this was only a 2-week extension by the CDC, and the airlines had already reached out to the White House earlier this month asking them to bring the mandate down. The White House disappointed with that moment from a briefing late yesterday. Jen Psaki had only known about it for a short time, and the line from the White House is stand by for news. This is going to the Department of Justice now to review the decision, and we'll find out if they plan to take any legal action. But to your point, some are suggesting this could be a gift to the administration and to Democrats at large in a midterm election season when these mandates are very unpopular with about half the country, and it's something that they may not have to talk about the rest of the year.
Delta Airlines said this in a statement. Here it is, Joe, I'll read it. We are relieved to see the US mask mandate lift to facilitate global travel as COVID-19 has transitioned to an ordinary seasonal virus. Do you think the administration is ready to treat it the same way?
I'm not sure that's the language that we're going to be hearing, 24 hours after the CDC says they still recommend masking. I'll be curious to see where we are, for instance, though, by the end of the summer and what the language sounds like there. We should note Uber was quick to follow, Amtrak too. Jonathan, I was on an international flight and on an Amtrak train, both in the last week. The enforcement on Amtrak was far more severe than what I experienced in the air. So everyone is going to be potentially living in a brave new world here.
Joe, looking forward to the program a little bit later. Sam Don, Bloomberg Radio, weekdays at 5 p.m. I don't know about your experience flying over the last couple of years. My problem hasn't been the mask mandate. Taylor Riggs, my problem has been the enforcement of the mask mandate. The relationship between customers and airlines right now has been absolutely dreadful. And the customer experience, I think in some cases, has been absolutely shocking. And I hope we go some way to taking the burden off the airlines and getting back just to a traditional customer service provider relationship that has been sorely lacking over the last couple of years.
And John, that's really where we're going to try to fold in the exuberance of the headlines with the fundamentals of the company, right? When you think about the customer experience and, of course, the share price reaction, where you get that immediate exuberance here, you, of course, have airlines a little bit higher on the day. You already talked about sort of the big six, some of the differences in the statements coming out between the two. But, of course, sort of that long-term picture, despite the positive news, at least for today, has been a big hole to climb out of. I mean, our Dan Curtis, producer, was doing some big analysis going back to 2019. Still one of the underperformers, still one of the only sectors in the negative, and still down about 25% from some of those 2019 levels. So really an industry that's been hit so hard and really trying to climb its way out of. I think sort of that bigger question, John, and you know this from a lot of your international travel as well, is that international travel has been hit a lot harder as well. And when you think about profitability, clearly international has been much more profitable than some of the domestic flights. Here, this chart here looks at revenue, passenger miles in the last quarter, breaking it down from domestic, and you just see the hole that international is in. And that here is the conundrum as we think about, does removing those masks sort of help the travel industry rebound?
Taylor, if we can just recap the earnings we have had in the travel industry from the airlines. Last week we had Delta. The numbers from Delta were really encouraging. You're going to be looking at Netflix after the close as well. Run through what you're getting from the earnings at the moment and the forward look that I think we're all sort of wrestling for. And that's what we started this hour with.
Yeah, you know, I guess we could go back to the classic age-old theme of inflation. When you think about Netflix, it's all about pricing and the pricing power. Does that create churn? Are you going to be canceling Netflix like you did Hulu? Maybe not, right? When you think about Porter's Five Forces, who is the pricing power? Netflix does. That, though, of course, will be one to watch. When you talked about airlines, John, with Delta, it was all about some of the record sales, right? So maybe not selling the number of tickets, but they're having that pricing power and being able to pass on those costs to the consumer. So I guess still for me, inflation very much front and center.
Taylor Ricks, thank you very much. BofA actually came up with their sum of earnings so far, and so far, I stress so far, because we've got so much more still to come. I'm looking forward to Apple on the 28th in about 9 days or so. BofA picked out two companies, Delta One. I'll read the quote. Delta issued impressive 2Q22 guidance, supported by a strong recovery in both corporate and leisure travel. They picked out Fastenal as well, one of the industrial companies here stateside, also beating on both sales and EPS with increased demand and pricing outpacing cost inflation. Wall Street took the story in the last week on the earnings front. We saw the underperformance of the banks year to date. We saw it last week too. Bit of a bump in the last 24 hours. But if you take those two companies, there is a decent picture out there for Main Street that maybe we weren't anticipating for the likes of the airlines, given what's happening with inflation and these big questions about where on the discretionary spend consumers will pull back, given that CPI is at 8.5%, gas prices and food are through the roof. From New York, up next, we'll get to the trading diary and run you through the events through the rest of this week, with the main event coming on Thursday with Chairman Powell and President Lagarde of the Federal Reserve and ECB, respectively, sitting down for a panel in Washington, D.C. Looking forward to that. From New York, this is Bloomberg. On a sector basis, the winner of the year, the loser of the session, just about in negative territory, energy equities. Everything else doing okay. The S&P up 0.6%, the Nasdaq 100 up 0.4%. Netflix earnings, as we've said repeatedly, coming after the close a little bit later. In the bond market, some big moves to talk about, stateside and in Europe too, on both sides of the Atlantic. The 10-year Treasury up 6 basis points, 291. A German 10-year up 10 basis points, 94 basis points. A German 10-year higher, yield up. The US 10-year yield higher, up. In Japan, nothing's happening. All month so far, we're up just 2 basis points, and that's why you've got that renewed yen weakness again. Dollar yen, for 13 straight days, we've had yen weakness, a record losing streak for the Japanese currency. That's the price action. Let's get you the trading diary. President Biden discussing infrastructure at 2:45 Eastern Time. We get a host of Fed speak on deck with President Evans and Kashgari later today. The earnings after the close, Netflix, followed by Tesla and United on Wednesday. today. Delta really tidy last week. Can we get a repeat of that act from United Airlines in the next 24 hours? And then on Thursday, it's the big one. You've got a panel between Chair Powell and President Lagarde of the Federal Reserve and ECB, respectively. Looking forward to that. We round it out with some data, with initial jobless claims coming up on Thursday morning. So from New York, that does it for me. For our audience worldwide, this was the countdown to the Open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Tuesday, April 19th. Here are the top market stories we are following for you at this hour. How about 75? St. Louis Fed President Jim Bullard wouldn't rule out a 75 basis point rate hike. Yields jump in the 30-year top 3% for the first time since 2019. Meanwhile, the IMF cuts its growth outlook, hikes its inflation one. We'll speak with its chief economist this hour. No more masks. U.S. Airlines, Uber, and Amtrak lift their mask requirements after a judge overturned a federal mandate yesterday. The White House calls the decision disappointing. And Apollo enters the chat. The Twitter saga continues as Apollo Global Management is reportedly interested in helping finance a deal by Elon Musk or another bidder. The participation could come in the form of credit or preferred equity. From New York, I'm Kaylee Lyons with my co-host in London, Anna Edwards. Alex Steele and Guy Johnson are off today. Welcome to Bloomberg Markets. So Anna, we get to spend a little bit more time together. We absolutely do. It's great to be here this hour with you, Kayleigh. And of course, the big focus for us today, very much on what's happening with Treasury markets and with bond markets more broadly. We've heard these comments from the Fed's President James Bullard. He's not ruling out a 75 basis point hike. He spoke with us about that, of course. But Kayleigh, this is something that is really front and center for markets. It's something that's influencing risk assets, for example. Absolutely, and sending yields surging not just here in the U.S., but really across the world. We should mention, though, this isn't necessarily his base case. He was speaking about this economic outlook at a virtual event yesterday hosted by the Council on Foreign Relations. Just take a listen to what he said.
In that cycle, there was a 75 basis point increase at one point. So I wouldn't rule it out, but it's not my base case here.
And that hawkish rate comments, of course, is hitting the markets today. And Anna, we were throwing this around in our morning editorial meeting. How do we talk about the bond market and Jim Bullard? It brought us to our question of the day, which is Bullard driving the bond market? Let's ask Michael McKee, Bloomberg's international economics and policy correspondent, as well as Kate Battis, Grace Capital president and CIO. So Mike, let's start with you first, since you're our resident Fed whisperer. Is 70 basis points realistic, or is this Jim Bullard once again kind of coming out of left field swinging?
A little bit of both, in the sense that it's realistic, and Bullard made the point there that in 1994, the Fed raised interest rates 300 basis points during the year, including a 75 basis point move. So it's been done before. The question is, does the Fed feel, A, it's necessary, and B, that it would not have a negative effect on the market? A what do they know that we don't know kind of aspect to it. So it's also a little bit of math, because if you're going to go 350 basis points this year, you're going to need a 75 or a whole bunch of 50s to get there. But as he said, it's not his base case, so it's probably not likely. But as he said, if necessary, I guess if that means if inflation keeps rising significantly.
Okay, let's bring Kate Battis into this then, Grace Capital president and CIO, as Kayleigh mentioned. Kate, your expectation around Federal Reserve interest rates, I mean, as Mike was saying, it's not Bullard's base case 75 basis points. What are you expecting?
I think the Fed, the 10-year is oversold. I'd be buying at this level. I think the appropriate rate should be more like 2.25%. I don't care what he says. Despite all this talk about inflation, long term, we've been in a 25-year deflationary trend. So I think the market's getting ahead of itself. Now, the Fed can do what it wants. They're the marginal buyer. They have the biggest balance sheet, and they can make the rates whatever they want them to be. But I just don't think the fundamentals support anything near the 3.25% 10-year.
Okay, Kate, but let's talk about the Fed's reaction function, not just where the bond yield should be. Do you not think that they're far behind the curve here as we see the IMF joining the chorus today and hiking its inflation outlook?
I do not. I think that we get in our little chattering classes. Everyone's talking about inflation. Remember, a year and a half ago, no one wanted anything to do with oil. Now we're saying oil is going to be $150. So I think we get in these modes. We're all talking the same thing, and we go in one direction. So I'm going to be a contrarian on this one. I think that as things play out, you will see that there are lots of deflationary trends in the U.S. economy. The economy is strong. The credit markets are strong. I'm going to hold on to my position on this one.
Okay, Kate, that's really interesting. Over what kind of time horizon are you talking about here? Because yes, you're right that a lot of voices seem to just be talking about inflation, whether that's Western central banks or many of the guests and strategists we talk to, and inflation has been underestimated by central banks, and central banks are behind the curve has been the dominant narrative. But there are increasing numbers of warnings, and the downgrades to global growth from the IMF and the World Bank are those, increasing numbers of warnings that perhaps we're going to need to focus not on inflation, but maybe on growth in the second half of the year. So what kind of time horizons are you talking about?
I'm really looking at the next 2-3 quarters. Look at what the companies are reporting. We're just getting into reporting season. Bank of America reported yesterday. I listened to the call. They reported strong loan growth, deposit growth, client inflows, and they made some very interesting comments. The size of the economy is bigger than it was in pre-pandemic levels. Consumer spending remains strong. Credit is widely available. Customers' usage of credit lines is low. Synchrony Financial also reported. So there are a number, JP Morgan reported. So yes, gasoline prices are up 22%, but the consumer's in good shape. JP Morgan, Citigroup, credit card spending is up 29%, 33% for Wells Fargo. So I'm looking at what the companies are saying.
Okay, so Mike, let's bring you back in here, because speaking of what the companies are saying, we've heard from your interviews with Fed presidents really across the board that the companies in their districts are telling them, hey, we can exercise pricing power. We have the ability to pass these costs on, and that creates actually a little bit of a problem for the Fed. If we see the continued ability of companies to do that throughout this earnings season, does that not just reinforce a hawkish Fed?
Well, it does to a certain extent. The Fed is finding that a lot of companies are saying it's getting easier to find people to hire. It'll be interesting to see the next jobs report. Won't influence the Fed decision because it's 2 days after that. But if we are continuing to see the labor market heal and start to rationalize, then the idea is we will probably see a little bit of a slowdown in wage growth and pay growth, and that will help as well. I think that the idea that we look too far ahead for recession is true. The remember yield curve inverting like a couple of weeks ago, and we were having questions. The daily question is, are we going to have a recession? And Jim Bullard said he doesn't think we're going to have a recession, even though he wants to raise rates significantly above what neutral is. So we're going to go back and forth on this in the markets, and the Fed is going to try to ignore all that as much as possible and try to focus on what's happening in the economy.
And Mike, thinking about what we heard from James Bullard, around 75 basis points, not his base case, as Kayleigh rightly points out, but something that he was asked about and he didn't want to rule out. What purpose does it serve for Fed presidents to make that kind of comment? There's a concept in politics called the Overton window, where you sort of open the framing of the debate to wider territory, and it helps to normalize things that might have been at the extremes previously. And I just wonder whether that's what might happen here. You know, you talk about 75 and it just makes 50 look more expected.
Yeah, somebody was pointing out this morning, Anna, that at the beginning of the year we were looking for 4 rate hikes from the Fed. Now we're looking for as many as 10. So it does fit into the widening of possibilities as inflation has gone up. There's just so many wild cards out there. You have an almost recessionary forecast for Europe coming down from the IMF and World Bank because of the war there. How does that play out around the world? And what does China's slowdown because of the lockdowns mean for the global economy, and how does that rebound back into the United States? It's really hard to say that something is going to happen. I think Bullard is just specifically honest when he's asked a question, but as he said, it's not his base case, so he's not out promoting it the same way he is promoting the idea of a 50 basis point move at the next meeting and getting to 3.5.
All right, well, Kate, Mike brought up a lot there. War in Ukraine, the outlook around China, just a lot of uncertainties that this market faces. In that kind of environment, where are you putting your money, whether on a regional level or on a sector level?
In that environment, I'm putting my money in the U.S. Okay, there's been a lot of talk about the U.S. no longer losing its status as a reserve currency. I don't see this happening. The euro has proven itself to be unstable as a currency. Look at Brexit, look at the French elections. The euro could even fall apart. China is highly unpredictable, you know, on the government level, and then you have this war in Ukraine. I think the U.S. is a great place to be. Look at the U.S. dollar-yen exchange rate. Trading at the yen's at a 20-year low against the U.S. U.S. raising rates is pulling in money from all over the world, the carry trade. I think all of this is going to be favorable. The U.S. dollar continues to be strong. I think it'll remain strong. And lastly, I'll say very quickly, look at the Silicon Valley. Anything you do in the world, you have to touch Silicon Valley. I call it the Silicon Valley tax. They levy a tax. You want to go on the internet, you want to date someone, you want to buy airline tickets, U.S. is the place to be.
And what is your latest take then, Kate, on the earnings story that we've got from the US so far? We haven't got all the way through, we haven't got that far through the earnings season, but what kind of messages are you taking away in terms of appetite to load up on stocks? Because some talk about the US equity market in particular as being pretty expensive here.
U.S. equity market is expensive. I think we're going back to, you know, what's the alternative? Where are you going to go? Yes, the 10-year, I'm going to repeat it, the 10-year at almost 3%. That is an alternative. I think that's why I'd be a buyer of the 10-year, not a seller. Long term, if you're a buy and hold long-term investor, I think you have to be in tech. Medium, short-term energy is looking good. Alternative energy, very good. Defense and cyber defense. Look at a Zscaler, a Palo Alto, a Fortinet. These are areas, CrowdStrike. You're seeing what's happening in Russia and Ukraine. Those are areas that are very attractive.
Kate, just quickly, a final question as we're going to start seeing big tech reports with Netflix after the bell today, a number over the next week or so. How do you differentiate in technology between what is maybe too expensive and what is not?
It's very easy. I would buy the big ugly fangs. I think they're the place to be. Google, Microsoft, and they're not Amazon. They're not that expensive. And then you have these companies that are still going to be around. They're very real, but they're trading at 10, 20 times revenue. Those are the ones to avoid. I would stick with the big ones.
All right, Kate Faddis, a contrarian with conviction. Thank you so much for joining us today. She's Grace Capital President and CIO, and Bloomberg's Michael McKee. Thank you very much as well. Now coming up, planes, trains, and automobiles. These are all forms of mass transit in the U.S. where masks are no longer mandatory. Yes, we can take them off. We'll have more next. This is Bloomberg.
Sponsor Bank of America.
Season is here.
A moment of multiple crises.
Bloomberg is fastest with the numbers and analysis.
You do have some good news and bad news.
It's a good time to own volatility.
Bloomberg, the fastest numbers and analysis you trust.
Welcome back to the program. Now, Americans no longer have to wear masks when riding on most forms of mass transit. Most major U.S. airlines and ride-hailing services like Uber have ditched mandatory face coverings after a federal judge's ruling. For more, let's bring in Sam Fazeli of Bloomberg Intelligence. Sam, good to speak to you. And, you know, we talked many times about masks and the use of them in different geographies and for different reasons. And we seem to be coming to the end of at least a federal mandate around masks. Are things just going to be left much more down to individuals? I suppose I'm talking here about the United States specifically, certainly not Asia and possibly not Europe as well.
But Anna, we already did that in the UK. I mean, except for the planes part. Most of the transport, you're advised perhaps to wear one. So I'm not surprised that's where it's going. It's one of the key symbols of the pandemic, and people want the pandemic to be behind them. But should they do it? even though they're told that you can do it. I mean, today on my train in from the airport, I wear a mask. I don't want to catch it. Why do I put myself in that position?
Well, and to your point, Sam, even though we all wish it would be, the pandemic is not over yet. We're still seeing new variants or variants of variants emerging. Should we expect, as some of these rules get relaxed, that we'll see an increase in cases?
Yeah, the more people mix, the less opportunity, the more opportunity we give the virus to transmit between us, which a mask would, to a degree, will reduce. Then you get more infections. But I'm hoping that infections will continue to fall, at least in some areas. The problem is the virus is making itself better and better at infecting us. Hopefully the vaccines will continue to do the magic that they're doing, which is seriously preventing severe disease.
Unlike you, I didn't wear my mask on the tube today because, as you say, the mandate's gone. You're asked to wear it if you want to, and sometimes I put it on when it's busy. I sometimes don't wear it when it's not busy. One thing we are focused on, though, is how the earnings story is going to change for certain drug companies that operate in this space. I'm thinking here about J&J in particular, suspending their COVID shot guidance. They're not saying that vaccine sales won't happen, but they're suspending their guidance. Is this something we have to really watch for big drug companies?
Well, it's already impacted the share price of some of those second line vaccines, for want of a better phrase. Novavax is down meaningfully today. The fact is, in fact, their pharma business missed. It's a great pharma business, but it missed because of the COVID vaccine mostly. There were a couple of other products that missed. And they were 300 million short on the COVID vaccine. What it's telling us is that we are flush with vaccine, and that's pretty much what they've said. And people need to just roll up their arms and take not only their booster, quite a lot of people haven't even had the primary series, especially in the low-income countries.
Well, but of course, J&J, one-shot vaccine, it's different from the mRNA vaccines of Moderna and Pfizer and BioNTech. Should we expect something similar from them?
No, I don't think so. I think what could happen, those guys have already done quite a lot of what's called advanced purchase agreements. They've signed them up. So those numbers are, I hope, in the bag. I mean, countries can still step back from taking deliveries and wanting to renegotiate. And I think some signs of that have come across my screen, Kaylee. The point is, the J&J vaccine is just not, at least as a one-dose vaccine, which I've never believed it is a one-dose vaccine, not as effective in terms of whatever you've tested it against when it comes to the 2 or 3 shot mRNA vaccines. And it's tough now to compete in that space.
Meanwhile, we're thinking about a very different story, a different situation in China. They've been really successful at keeping the death rate down, of course, from COVID-19, but that's partly because they've been very effective at keeping it at bay to this point. Now things are very difficult for them, juggling the outbreak they have at this point and the economy. Where does this head, Sam?
Well, so, and I think they did a great job, and then Omicron came. Right? If you have a virus that takes a few days to infect and you become infectious, you can manage it by the methods but they're proven this is not going to be a genie they can keep into the bottle. And that's pretty tough. It's Omicron that's undoing.
Sam, of course, part of the issue in China is the lack of natural immunity because they just lock everything down when they do see outbreaks. As long as we're having issues like in places like China, how far away are we from this being declared endemic rather than pandemic?
Yeah, I think I've never been a big fan of that endemic pandemic phase. The day that the virus becomes essentially our daily, annual virus to live with, like everything else that we live with. When I came back from New York a couple of weeks ago, I came back with some infection. It wasn't Omicron, or it wasn't COVID. It was some other common or garden infection that we've been dealing with for years. So I think I pretty much believe that we're already there. This is the virus with us, and we're going to be managing it as we're doing, masks, etc.
Yeah, I'm still sitting here. Am I going to put my mask on when I get in an Uber home today? I don't know. I feel like I'm just going to have to go with my gut feeling in the moment. Thank you so much. Sam Fazeli of Bloomberg Intelligence. Always appreciate your insight on this. Now coming up, we'll turn to a company story that we have all been watching for weeks now. Now, Apollo Global, the PE firm, is also going to be eyeing Twitter and the saga there. We'll have those details next. This is Bloomberg.
About that all day yesterday.
Twitter has bought itself some time with that poison pill defense. The move, of course, is aimed at thwarting Elon Musk's unsolicited takeover bid. Meanwhile, PE firm Apollo Global is reportedly interested in helping finance that bid, either by Elon Musk or potentially another private equity player for a deal for Twitter. Joining us now with the details, Bloomberg's Ed Ledlow. All right, Ed, so Apollo reportedly is entering this conversation. Are others likely to join in?
This forecast, right, where this company is ripe for private equity. There's no dual class share structure. You'll remember when the poison pill was instituted, Elon Musk replied to a tweet saying that in his opinion, the poison pill was used not necessarily to deflect Elon Musk, but in Elon Musk's opinion, it was the board taking notice that other bidders would come in. You know, it was one of the hypotheses of Bloomberg Intelligence, other participants on the street for some time. And, you know, this deal, according to sources, would be Apollo supporting a Musk bid, potentially them supporting another private equity bid, or even some media have reported going to Twitter directly and doing a deal with them, which would ward off some of the takeover interest.
Okay, good morning to you, Ed. So this story twists and turns. Apollo might or might not want to be part of it, then we understand. We also heard from Elon Musk tweeting, as of course it would be appropriate in this story, love me tender. A lot of people then saying, does that mean he's coming through with a tender offer for the business? I mean, where does Musk go from here, I suppose, having heard about the poison pill, whether he thinks it's directed at him or not? Do we have any sense of that?
Yeah, he expressed doubt, right, during that TED Talks last Thursday that any deal for him, at least, would even happen. You know, the tender offer is an option. If he were to do it, we'd get a regulatory filing. So, you know, Anna, you're lucky in London, you'll be awake anyway. But I keep joking with Kaylee that it's a good kind of week to get up at 4 a.m. Eastern and watch the terminal for these regulatory filings, because that's how it would be communicated. And then, you know, we've spent all week talking to securities and M&A experts, right? If he does go forward with a tender offer, the board has little choice but to consider it. Otherwise, we move into territory where we're headed towards a proxy fight. I would note, speaking to investors, speaking to insiders at the company, the big jump we saw in the shares Monday, 8% gain, was the biggest since April 4th, when Musk's stake was first disclosed. And the psychology of the market is we're moving towards a place now where the outcome is more beneficial to shareholders than it was, say, a week ago, whatever happens.
Yeah. Well, and of course, Ed, Elon Musk only has so much attention he can devote to this because he's also busy running SpaceX and Tesla. And just quickly on Tesla, earnings tomorrow, what is the number one thing you're watching out for?
Yeah, I think Shanghai. We're all wondering what the impact of the shutdown of the plant there is, because it's the heartbeat of their global production efforts. You know, they had a stellar quarter first 3 months of the year, but a lot of that energy in production delivery is weighted towards the back end of the quarter. That's when the plant was shut down. So one side says they could have done even better, but it has been a prolonged shutdown and it could impact their sort of overall numbers for the year.
Ed, thank you very much. Bloomberg's Ed Ludlow with the latest on Twitter as that saga continues to roll and roll. We will watch that with interest. Coming up on the programme, Ukraine says Russia has launched a full-scale offensive to take control of the Donbass area. We'll have the latest on what's happening on the ground. This is Bloomberg.
We are an hour into the U.S. trading session. Bloomberg's Kriti Gupta is tracking the moves. And Kriti, if I took a look at the bond market, I might think that the equity market would be down, and yet that's not the case.
It's not the case. It's kind of like a spring in my view. Remember, this is the first day that you are actually seeing all of these investors come back, not just here in the States, but in Europe as well, and especially Asia. Remember, coming after that long Easter holiday, it's only natural to see a little bit of momentum coming into the market. And that's kind of what you're seeing here. That momentum led by tech. I believe all 11 sectors of the S&P 500 in the green right now really speaks to that breadth that you're seeing in the market. Just about 30 minutes ago, I believe, when the market actually, or about an hour ago when the market actually opened, I think only 10% of stocks were actually in the red, all due, I want to say, to fundamental reasons. But to Kaylee's point, it's not just yields you want to watch that dollar too. As you start to see that dollar strength, does that disincentivize some of those foreign investors to hop into the market? Right now, we are not seeing that, but certainly something we'll keep an eye on. And another thing to keep an eye on is going to be the economic data. Remember, we have a lot of gloom and doom around us talking about whether or not the economy is going to slow stateside. Well, check this out. If the home builders or if the housing starts is your kind of gauge for that, two different messages here. The white line here showing housing starts, which surged, by the way, and the yellow line is the home builder stocks. Usually, as you can see, they kind of move in tandem, but right now you're seeing a little bit of a divergence. Is the market front running what they're expecting to see in the housing market? Essentially a drop when it comes to those housing starts. The underlying economy, though, the data, which of course is backwards looking, still showing that the economy is running strong. Let's go from the macro, though, to the micro, because you do also have plenty of individual stories. Johnson & Johnson, an interesting move here, up 3.4% despite suspending their vaccine sales guidance. They're saying concerns around global supply, demand uncertainty, it's actually weighing on that. Therefore, they're going to take it out of their 2022 guidance. That being said, the stock is rallying, and that might simply be the idea that it's not as impacted by those vaccine sales as say, Pfizer or Moderna, which of course have more of a lead when it comes to that vaccine distribution. We should also talk about Hasbro. They missed their earnings, but they are planning to resume their buyback. So you are seeing that share price react more to the buyback story than to the earnings story. I'm going to end here with Plug Power, getting a contract from Walmart. Some of those forklifts going to get powered by liquid hydrogen fuel. Usually we see Plug Power move in line with the EV trade, the green trade, but today moving quite big on that contract from Walmart.
Kriti, thanks very much. Bloomberg's Kriti Gupta with some of the big moves of the day. Now, in Ukraine, President Volodymyr Zelensky says a long-anticipated Russian offensive has begun. Russian forces are said to be targeting the Donbass region in the eastern part of the country. The assault is taking place along a front of more than 300 miles. Bloomberg's Mark Champion joins us now. Mark, of course, we've seen violence in the Donbass, just as we've seen violence in other parts of Ukraine over recent weeks. In fact, violence in the Donbass goes back even further, doesn't it? What is important to know about this area and this region and this week? Is the conflict really intensifying there?
Well, I mean, the first thing is that in terms of the conflict, there's a defined goal that the Russians have for now, and that is to take these two regions, Donetsk and Luhansk, in their entirety. They've had about a third of it since 2014. And they've taken, more of it, more than half in total now since this war began, this new offensive in February. And they're now trying to take the rest. The other thing to remember is that really the heart of the Ukrainian army is stationed here. It's been fighting here for 8 years. There are large chunks of the army that are kind of stuck in trenches, and they've been, their loss would be very dangerous for Ukraine. They're also much further away from supply lines in the west than Kiev, for example. So they will have more difficulty with logistics of the kinds that Russia had early in the conflict. So it's a different kind of battle. It's in open terrain, not in urban situations.
Well, let's talk about the weapons that may be used in this battle, Mark. We heard from Sergei Lavrov, the Russian foreign minister, earlier today in response to a question about whether Russia would use nuclear weapons. He said that Russia will only use conventional weapons in this war. A, can that be believed? And B, does that also rule out chemical and biological?
Well, whether it can be believed, I mean, you should believe nothing in terms, during times of war, that officials say. And he may actually intend, it may be genuine in what he says today, but, circumstances can change, in which case Russia has doctrines and it has the capabilities to use non-conventional weapons, including nuclear, and it should not have any chemical weapons, but we know that it does because it's deployed them in small amounts in different places. It really doesn't tell us much, except the immediate intent of the Russians is that they don't want to use those. They think they've got enough in terms of conventional power.
We understand, Mark, that President Joe Biden will hold a call with key allies sometime during today to discuss Ukraine, and the focus seems to be around supplying or coordinating supplies of weaponry to Ukraine. We have recently heard about step-ups in the level of supply, certainly from the United States. What would you expect the focus to be?
Well, it'll be about the quality and quantity of weapons that need to get to Ukraine now if those forces in the east are to hold. The Russians have obviously concentrated a significant amount of new troops and hardware in the area. There were some reports and video footage on social media today of armor moving north from Mariupol now that the defense of Mariupol has largely collapsed. The Ukrainians need to be able to respond, and as I said, this is a different kind of terrain, so they need, they need to be able to defend themselves against air attack. They need long-range artillery in order to be able to take out the artillery that's shooting at them. They need tanks, they need mobility, and all of this needs to come very quickly across a long distance that the Russians are now also targeting. Yesterday they were targeting all the way across Ukraine, different pieces of infrastructure, and in particular transport, for exactly that resupply reason.
All right, Mark Champion, Bloomberg's Mark Champion, thank you as always for your great reporting on this. We really appreciate it. Now coming up, we'll turn to the war's economic impact. It's led the IMF to slash its growth forecast by the most since the early months of the pandemic. We'll be speaking with the organization's chief economist, Pierre-Olivier Gouronchaud, next. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Rishika Gupta. China sees multiple risks to the economy as the coronavirus outbreak keeps growing. Still, it's pledging to meet its ambitious growth target and stabilize jobs. The state-run news agency said the economy still has many strategic advantages. China has set a growth target of around 5.5% for the year. U.S. Treasury Secretary Janet Yellen will participate in some sessions of the Group of 20 this week. The U.S. is backing off any suggestion that its officials would boycott G20 meetings if Russia takes part. Yellen will avoid some meetings of the G20's finance ministers in Washington, but she will attend others focused on the economic fallout from Russia's invasion of Ukraine. And in Ukraine, President Volodymyr Zelensky says a long-anticipated Russian offensive has begun. Russian forces are said to be targeting the Donbass region in the eastern part of the country. The assault is taking place along a front of more than 300 miles. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg. Kaylee.
Ritika, thank you. Well, speaking of Russia's invasion of Ukraine, it has driven the IMF to slash its global outlook for global growth. The IMF released its report earlier today, cutting its global forecast this year from 4.4% down to 3.6%. U.S. expansion was cut by 0.3 of a percentage point to 2.3%. With us now is the IMF's new chief economist, Pierre-Olivier Gouronchaud, who is joining us now. Pierre-Olivier, great to speak with you. Of course, this forecast includes information through the end of March. Things are changing very quickly. A lot has changed since then. What downside risks to growth and perhaps upside risks to inflation have developed since then?
Well, first, Kaylee, great to meet you and very happy to be here. In terms of our revisions to output growth in our new World Economic Outlook, the dominant factor is the war. And that's true for the baseline, but that's true also for the downside risk. So when we think about the downside risk to the global economy, an escalation of the war or a tightening of the sanctions, in particular an extension of the sanctions to energy trade, energy exports from Russia, would have a significant impact on global output and on output in neighboring countries, in particular in Europe. That's not the only downside risk that the economy is facing. There's also potentially a stronger slowdown in China. We've heard the numbers coming out yesterday and the measures that have been taken, announced just this morning. There's also the risk that inflation might be more elevated than what we've had and require more tightening from central banks. But the war comes first.
Yeah. Pierre-Olivier, good morning to you. How weak would European growth become if we did see a ban on imports of Russian gas? Do you have a range of outcomes, a range of possibilities, any sense of how weak that growth story could be?
Well, a lot of people are looking at that very question right now, including in our own institution. The key issue there is that it would be very difficult to substitute part of the natural gas that Europe is importing from Russia through pipelines in the short term, so within 1 or 2 years. And so that would have a serious impact on prices. It would have a serious impact on activity in the region. We have, in our report, we've run an adverse scenario situation where we imagine that the sanctions are stronger on energy exports from Russia, accompanied by other factors like more financial instability and maybe a weakening of consumer confidence around the world. And when we run the scenario, we have a much larger decline in output. We anticipate for the global economy that output would be 2% lower. That's a level effect. That's not a growth effect by the end of 2023. And for the euro area, it would be about 3% lower by the end of 2023. So quite sizable effect. But let's realize that there's an enormous amount of uncertainty in making this kind of prediction. So we have to be humble in terms of understanding this.
So obviously there is a lot of uncertainty, but if you were playing the odds right now, where do you put them on the likelihood of a recession in Europe in particular?
Well, as of now, given where the sanctions are and have been, and despite some of the adjustments in the sanctions since then, the really big piece would be extending the sanctions to energy export from Russia. Until that happens, I think our baseline projections are reasonable. They anticipate a significant slowdown in Europe to about 2.8%. In some countries, it's an even stronger slowdown. Germany, for instance, we anticipate 2.1% growth. It's a 1.7 percentage point revision from January, so it's quite significant. But it still stays in positive territory, although it's a much softer level of activity.
Can I ask you about the Russian economy, Pierre-Olivier, because President Putin likes to point at the resilience, the rebound in the Russian ruble and say, look, that's evidence that the Russian economy has survived the attack of sanctions. That's the way he sees it. Of course, the sanctions threat could increase. Where do you put the pain and the resilience of the Russian economy right now? How negatively affected by sanctions do you think it will be?
Oh, the Russian economy is very strongly and negatively affected by the sanctions that are in place already. I mean, we are projecting a double-digit revision in output growth for Russia, 11.5 percentage point revision. So growth for Russia is predicted at negative 8.5 in 2022, so it's very, very significant. And it's largely coming from the contraction in imports and the financial sanctions that have been put in place on Russia, excuse me. And so here, clearly, what is very important to realize is that with financial flows are basically cut off, the ruble and the value of the ruble doesn't really mean anything. It doesn't really reflect the impact, negative impact that the sanctions have inflicted on the Russian economy.
All right, Pierre-Olivier, let's talk about China now, as we just touched on Russia. You've cut the China growth forecast to 4.4%. That's down from 4.8%. How much downside risk is there in that economy in particular, given that there is no sign of a let-up in its zero tolerance for COVID?
Yeah, so we have a mild revision downward in our projection for China from 4.8% to 4.4. So it's 4.4 is quite a bit below the authorities' target of 5.5 for 2022. So we are projecting a softer level of activity in China in 2022. And this is largely driven by three factors. One is, as you pointed out, Omicron lockdowns that have been extended and are already factored in our baseline, although we anticipate them to be rather localized and temporary. Then there is a softening of external demand. The rest of the world is not doing as strongly, and therefore China is affected. It's an export-oriented economy. And third, there is also some trouble brewing at home in terms of the property sector, and that's also weighing down on output. Now, going forward, the zero COVID policy is something that has served China very, very well in terms of number of cases and number of deaths in the past 2 years. But it's, of course, harder to maintain when you have a more virulent strain of the virus like Omicron is. And it's especially problematic when you have a high fraction of your elderly population that is not vaccinated yet. And so China is sort of in a race to try to close this vaccination gap